Welcome back, finance fans. Let us continue this second segment of retirement accounts. Retirement accounts. Traditional individual retirement accounts, or IRAs. One of the more popular retirement accounts is the IRA, which individuals fund directly. Before recommending investments in these individual plans, registered representatives should ensure that their clients are fully utilizing any employer-sponsored plans, as most employer plans allow for pre-tax contributions and may incur lower overall costs than self-directed accounts. So, any individual, regardless of age, who has earned income from employment during the year, can contribute to a traditional IRA. Earned income can come from wages, salaries, commissions, professional fees, and even taxable alimony. However, just to clarify, earned income does not include things like interest, dividends, capital gains from investments, income from annuities, or rental income from real estate. Under certain conditions, IRA contributions may be tax-deductible. However, in all instances, the income earned from investments in an IRA accumulates on a tax-deferred basis until withdrawn. An IRA account cannot trade on margin and must designate a beneficiary to receive the account's assets in the event of the owner's death. An individual may hold an IRA at either a bank or a brokerage firm. While the institution serves as a custodian for the account owner is responsible for deciding how the funds will be invested. They can choose from a wide range of investment vehicles, including stocks, bonds, mutual funds, annuities, or U.S. gold coins. However, funds contributed to an IRA cannot be used to purchase life insurance or collectibles such as art, antiques, or stamps. The income earned from investments in IRAs accumulates tax-deferred until withdrawn. Contribution limits are pretty important to keep in mind. The maximum amount an individual can contribute to an IRA each year is $6,000, or 100% of earned income, whichever is lower. Any contributions exceeding this limit are subject to a 6% tax penalty for overfunding. Individuals aged 50 and older can make an additional catch-up contribution of $1,000, raising their annual contribution limit to $7,000. Contributions must be made in cash, property cannot be contributed. Alright, let's talk about spousal accounts. If both spouses in a married couple are employed, each can separately establish an IRA and contribute a maximum of $6,000 annually. Now, married couples with only one employed spouse may also contribute a maximum of $12,000 per year into two separate IRAs, provided the working spouse has earned at least $12,000 annually. However, no more than $6,000 can be contributed to either account. The account for the non-working spouse is known as a spousal account. Moving on to the deductibility of IRA contributions. A single individual who is not covered by an employer-sponsored retirement plan can always deduct an IRA contribution of up to $6,000 from taxable income each year. The same applies to a married individual and their spouse, provided neither participant is in such a plan. However, if either the individual or their spouse is covered by an employer-sponsored plan, the deductibility of the contribution, whether it's full, reduced, or none, depends on the individual's taxable income. Now let's go over transfers and rollovers. An investor may transfer funds from one IRA to another without incurring taxes. A transfer happens when plan assets move directly from one trustee to another. There is no limit on the number of these transactions that may occur annually. An investor may also roll over distributions from qualified retirement plans, such as 401k plans, into IRAs without incurring taxes. In a rollover, the investor actually receives the money. To avoid a tax penalty, the rollover must be completed within 60 days and can only be done once every rolling 12 months. Okay, so early withdrawals from IRAs. If an investor takes money out of an IRA before reaching the age of 59 and a half, they'll have to pay a 10% tax penalty on the amount withdrawn, and in addition to that, they're also liable for ordinary income taxes on the withdrawal. The early withdrawal amount will get added to the investor's taxable income for that year. For example, let's say a 40-year-old investor earning $45,000 per year takes a $5,000 withdrawal from her IRA to move overseas. She'll need to pay a $500 tax penalty which is 10% of $5,000 for the early withdrawal, plus her taxable income for that year will be $50,000. Now, investors under the age of 59 and a half won't face a tax penalty for early withdrawals from an IRA if any of the following exceptions apply. The account owner becomes disabled, the account owner dies, and the money is withdrawn by the beneficiary. The funds are used to pay certain medical expenses not covered by insurance or medical insurance premiums when the owner is unemployed. And finally, the money is used for expenses related to being a qualified first-time homebuyer up to a $10,000 limit. So, there are a few more exceptions to the early withdrawal penalty. For example, if the funds are used for expenses related to the birth or adoption of a child, there's a $5,000 limit. Or if the money is used to pay qualified higher education expenses, including tuition, fees, books, and room and board, for the account holder or a member of her immediate family. That's another exception. Also, withdrawals that are structured as a series of substantially equal periodic payments taken over the owner's life expectancy can qualify. Now, even though investors who meet these exceptions and those aged 59 and a half or older will avoid a tax penalty, they'll still be required to pay ordinary income taxes on the amounts withdrawn. But if an investor is under age 59 and a half and takes money from an IRA due to financial hardship, she'll still be subject to the 10% tax penalty. Required minimum distributions, or RMDs, are something investors need to keep in mind. If you wait too long to begin withdrawing from your traditional IRA, you could face a hefty penalty, like a 50% tax penalty based on the amount that should have been withdrawn. The IRS will enforce this penalty if you don't start taking withdrawals by April 1st, following the year in which you turn 72. And just so you know, the age was raised from 70 and a half to 72 as a result of the Secure Act passed back in 2019. It's also important to note that this RMD requirement doesn't apply to Roth IRAs, since Roth IRAs are funded with after-tax dollars. Roth IRAs were introduced by the Taxpayer Relief Act of 1997, giving investors another type of IRA to consider. Unlike a traditional IRA, contributions to a Roth IRA aren't tax-deductible. And because investors contribute to Roth IRAs with after-tax dollars, they can withdraw contributions at any time without having to pay taxes. That's a pretty big difference, honestly. So, the accumulated earnings in a Roth IRA can also be withdrawn tax-free, provided the account has existed for at least 5 years and, well, one of the following conditions is met. The account owner is age 59 and a half or older, the account owner has died or become disabled. The money is used for qualified first-time homebuyer expenses with a $10,000 lifetime limit. The funds are used for expenses related to the birth or adoption of a child with a $5,000 limit. The money is used to cover certain medical expenses or medical insurance premiums, or the funds are used to pay for qualified higher education expenses. If these conditions aren't met, the account owner will be subject to ordinary income taxes plus a 10% tax penalty on the earnings generated by the contributions. And, just so you know, investors are not subject to required minimum distributions in a Roth IRA. Let's talk about contribution limits. The contribution limits for Roth IRAs are the same as those set for traditional IRAs, the lesser of $6,000 or 100% of earned income. A married person may also contribute $6,000 per year to a spouse's Roth IRA, even if the spouse is not employed outside the home or earns very little. However, total contributions to any one person's IRA, whether traditional and Roth combined, cannot exceed $6,000 per year. Okay, so let's talk about eligibility. Any person, no matter their age, is eligible to open a Roth IRA as long as their income doesn't go over certain levels. And, whether or not you're participating in an employer-sponsored retirement plan doesn't actually matter when it comes to figuring out if you can contribute to a Roth IRA. Now, just keep in mind, you could lose the ability to contribute if your adjusted gross income goes over a specific amount that the IRS sets. But here's something important. There's no income limit stopping you from converting your traditional IRA into a Roth IRA. Qualified retirement plans. Employee Retirement Income Security Act, or ERISA. So the purpose of ERISA is to prevent the misuse and mismanagement of pension plan funds, especially by the managers of these plans. To achieve this goal, ERISA sets standards of conduct for anyone dealing with pension plans. Qualified retirement plans meet both ERISA and IRS requirements and receive favorable tax treatment. To be qualified, a plan must be established in writing and must adhere to the following guidelines. First, eligibility requirements. The plan must cover all employees who are age 21 or older and have worked for the employer for at least 1 year. For determining full-time employment, working 1,000 hours or more during the year equates to full-time. Next, vesting. This refers to the schedule under which employees' rights to receive benefits contributed to a plan by their employers gradually become guaranteed based on years of service. At a minimum, all participants must be either fully vested after 5 years or 20% vested after 3 years, with full vesting after 7 years of service. However, employees are always 100% vested in the contributions they have made to a plan on their own behalf. Then, investment of contributions and determination of benefits. The investment of plan assets as well as other plan activities are governed by strict fiduciary guidelines. This concludes the review of the different types of customer accounts and various forms of account registration. The next video will concentrate on a broker-dealer's compliance considerations. Attention will be directed to anti-money laundering or AML provisions, record-keeping requirements, and public communication. So, be sure to enable your notifications to be among the first to see the next segment. We also invite you to show your support by liking this video and subscribing to our channel. A simple click for you means significant support for us, and it's completely free. Thanks.